Hello and welcome. When you first look at a stock chart, it can feel like you're staring at a chaotic, squiggling line, a meaningless mess of ups and downs. It might seem impossible that anyone could decipher a pattern or make a decision from it. But what if I told you that these charts are actually telling a story? A story about the battle between fear and greed, between buyers and sellers. Learning to read this story is the essence of technical analysis, and it's a skill that can help you make more informed investing decisions. This is true whether you're a day trader or a long-term investor just looking for a good entry point. Now, a crucial disclaimer up front: technical analysis is not a crystal ball. It won't guarantee you'll pick winning stocks, but it is a powerful tool for understanding market psychology and identifying potential trends and reversals. In this video, we're going to give you the beginner's toolkit for reading a stock chart. We'll cover the essential elements, the most common patterns, and how to use them without getting overwhelmed. So let's get ready to learn the language of the charts. Before we talk about patterns, we need to understand the canvas itself. What are we even looking at? Most stock charts you'll see are candlestick charts. Let's break down what a single candlestick tells you. Imagine a single candlestick representing one day of trading for a stock. The thick part is called the body. It shows the opening and closing prices for that day. If the closing price is higher than the opening price, the body is often green or white. This is a bullish candle, showing buying pressure was in control. If the closing price is lower than the opening price, the body is often red or black. This is a bearish candle, showing selling pressure was dominant. Then you have the wicks, which are the thin lines above and below the body. These show the highest and lowest prices the stock reached during that day. So, in one quick glance, a single candlestick gives you 4 critical pieces of information: the open, the close, the high, and the low. Let's think about what this means. A long green body with small wicks tells a story of strong, sustained buying all day long. A long red body tells the opposite story: sellers were in command from start to finish. A candle with very long wicks and a small body shows a lot of indecision. The price moved wildly up and down, but ultimately ended up close to where it started. Beyond the candles, you'll see 2 other key elements on most charts. First, there's volume. This is usually shown as bars at the bottom of the chart. Volume tells you how many shares were traded during that period. High volume gives a price move credibility. For example, a big price jump on high volume is much more significant than a jump on low volume, which might just be a false move. Second, you have moving averages. These are the smooth lines you see flowing across the price chart. They smooth out the price data to show the general direction of the trend. The most common ones you'll hear about are the 50-day and 200-day moving averages. A simple rule of thumb is that when the price is trading above its moving average, the trend is generally considered to be up. When it's trading below, the trend is generally down. So, now that we can read the individual words, the candlesticks, volume, and moving averages, let's look at how they form sentences and paragraphs. Charts often form patterns that suggest what might happen next. Think of these as the market's grammar. The most basic pattern of all is the trend. There's a saying in trading: the trend is your friend. An uptrend is simply a series of higher highs and higher lows. This shows the bulls, or buyers, are in control. A downtrend is the opposite, a series of lower highs and lower lows, showing the bears, or sellers, are in control. And sometimes, the price just bounces back and forth in a sideways or range-bound market. This indicates a period of indecision or consolidation. Now, this next concept is perhaps the most important one in all of technical analysis: support and resistance. Support is a price level where buying interest is consistently strong enough to prevent the price from falling further. You can think of it like a floor that the price has trouble breaking through. Resistance is the opposite. It is a price level where selling pressure is consistently strong enough to prevent the price from rising further. Think of it as a ceiling. Here's where it gets interesting. When a price finally breaks through a resistance level, that old ceiling often becomes the new floor or new support. The opposite is also true. When price breaks below a support level, that old floor can become a new ceiling of resistance. Now let us talk about some of the more famous patterns that can signal a big change is coming. These are called reversal patterns. One of the most well-known is the head and shoulders pattern. This pattern can signal a trend reversal from bullish to bearish. It looks just like it sounds: a peak, which is the left shoulder, followed by a higher peak, which is the head, and then a lower peak, the right shoulder. If the price then breaks below the neckline, which is the support level connecting the lows, it confirms the pattern and suggests a significant drop could be next. Then you have the double top and double bottom. A double top looks like the letter M and usually forms at the peak of an uptrend. After two failed attempts to break higher, the price often reverses and heads down. A double bottom looks like the letter W and signals the opposite, a potential reversal from a downtrend to an uptrend. Not all patterns signal a reversal. Some just suggest the trend is taking a breather before continuing on its way. These are called continuation patterns. A common example is the triangle pattern. These form when the price moves into a tighter and tighter range, getting squeezed between a rising support line and a falling resistance line. A bullish triangle that forms in an uptrend often breaks upward, continuing the trend. A bearish triangle in a downtrend often breaks downward. With all these patterns, it's very easy to start seeing shapes everywhere. This is a real phenomenon called pareidolia. It is the same reason we see animals in the clouds. So, how do you use this information responsibly without getting fooled? Step 1. Always start with the big picture. Zoom out on the chart. What is the long-term trend? Is the stock above or below its 200-day moving average? The context of the larger trend is far more important than any single, small pattern you might spot. Step 2. Look for confluence. A single pattern is just a hint. A cluster of signals is a much stronger suggestion. For example, a head and shoulders pattern becomes much more convincing if it forms at a major resistance level and is accompanied by declining volume as the pattern completes. When multiple signs point in the same direction, your confidence can be higher. Step 3, and this is the most important, use it to plan, not to predict. Technical analysis is best used as a risk management tool, not as a forecasting miracle. For instance, instead of saying "I know this stock is going up," you can use technicals to create a plan. You might decide, "I will only buy this stock if it breaks above this key resistance level on high volume," or "I will place my stop-loss order just below this support level to limit my potential loss if I am wrong." This approach creates a disciplined framework for your decisions and helps remove emotion from the process. It's also critical to remember the major limitation. Technical analysis studies the effect, which is the price movement, not the cause, which is the company's actual business. A beautiful chart pattern can be instantly invalidated by a surprise bad earnings report or a negative news headline. This is why many successful investors combine technical analysis, which helps with the when to buy, with fundamental analysis, which helps with the what to buy. So, let's do a quick recap. The basics: candlesticks show the daily battle between buyers and sellers. Volume and moving averages provide crucial context to what's happening. The patterns, support and resistance, trends, and specific shapes like the head and shoulders can tell stories of potential reversal or continuation. And the smart approach: use technical analysis as one tool among many. Always look for a confluence of signals, consider the bigger trend, and use it to create a disciplined plan for your entry and exit points. Reading a stock chart is a skill that takes practice. You won't become an expert overnight. A great way to start is by simply observing the charts of companies you already know. See if you can identify the trend. Try to spot areas of support and resistance. Over time, as you watch these stories unfold on the chart, you'll become a more confident and disciplined investor for it. Thank you so much for watching. If you found this helpful, please give this video a like and subscribe for more content to help you on your investing journey.